Welcome to the Nano podcast. I'm your host, Will Chernlin, and I'm excited to have you join me on this journey through the world of nano companies. For the past decade, I've talked to thousands of business owners across various industries. It's been an enlightening experience revealing the vast tapestries of entrepreneurship and innovation that thrives beneath the surface of mainstream media coverage. Each week, I will interview different leaders of nano-cap publicly traded companies to learn about their history, what they do now, and their future. As a reminder, none of this information is financial advice, and it is all for entertainment purposes only. Let's start this week's episode. Hi, on this week's episode, we have Dom Wells. Dom Wells is the CEO and founder of Onfolio, stock ticker ONFO. Onfolio buys digital companies from independent entrepreneurs and grows them to their full potential. Dom, thanks for coming on the podcast.
Yeah, thanks for having me. Looking forward to it.
So I like to usually start with guests kind of going before their Wikipedia page or their LinkedIn page starts. So before you got into entrepreneurialism, what were you up to? It looks like it was in the UK too. So what were you doing in the UK before you started doing your entrepreneurial journey?
Yeah, I'm from the UK, but I guess, so I graduated and then I did a couple of basic jobs, like I worked in a bar and stuff like that. And then I headed to Taiwan when I was 23. The original plan was to teach English for a couple of years. And I ended up staying much, much longer. And when I didn't want to teach English anymore, that's what was really my start in entrepreneurialism. I thought, okay, can't get a local job, don't want to go back home, don't want to teach anymore. So, the internet is maybe the alternative. So I read all the classic books like The 4-Hour Work Week and Rich Dad Poor Dad, and just kind of stumbled along until I figured out how to make money online more successfully.
About what year was this?
So I first started 2012. August 2012. So yeah, it was like 12 years ago. I graduated in 2006. So I'd been kind of, 2012, I was now like 27 years old. So basically I was around there.
Yeah, that sounds right around 2012. I was living in my aunt's basement up near the Canadian border, listening to the Tropical MBA podcast and the Empire Flippers podcast. Reading the 4-Hour Work Week, was in the same kind of mindset of like, how do I actually do this internet thing? So no, very cool. So you're teaching English in Taiwan. And then did you just start kind of sprouting up some affiliate websites? Did you start writing blog posts, or what was your initial first step?
Yeah, that was exactly it. So I discovered a course, like a community, which teaches you how to do affiliate marketing, and SEO and ranking sites in the top of Google. And that was my path. So there's lots of different ways of making money online. For me, it was starting these niche affiliate websites. So I had a website about kettlebell exercises. I had a website about shaving. So it's like things like best razor. Once upon a time, if you typed best cutthroat razor into Google, I was number one. And that article made me, I don't know, $500 a month. And I had a bunch of these different articles and a bunch of different websites. And I kind of, scaled it from there. And then I started Human Proof Designs, which was a service where we basically said to people, if you want to get started like we are, we'll teach you how to do what we do, and we'll build you that beginner website with like all the backbones and everything, and then it's your job to then grow it from, we've kind of given you a business in a box. And then that was like my first real success. That was, I think I was making say $1 or $2 a month before I started that website. And I was very clear to people. I was like, look, I'll give you a starter website, but I'm only 6 months ahead of you in my journey type thing. But Human Proof Designs was where I started being able to pay myself like $10K a month, $15K a month, and then first $1 million revenue business, that kind of thing. That was the real life changer for me.
So you're scaling Human Proof Design. You're getting a hands-on look at exactly kind of what affiliate marketing businesses work, which ones are easy, which ones are hard. You're learning SEO, you're learning all these valuable skills. When did that start turning into the idea of Onfolio?
So I had the idea for Onfolio in 2018. So I started Human Proof Designs in 2014, so sort of piecing together the timeline here. And I think 2015 or 2016 was when I first bought a website rather than building from scratch. And initially it was because I bought a competitor of Human Proof Designs, and I thought, hold on a second, like this is way better. I can just buy stuff instead of build. And then as I got a bit more money, I took a PayPal loan and bought another business. PayPal loan is not a very good interest rate, but it allowed me to buy a business, which I then grew, and so it was worth it. And so it was kind of on my mind thinking, this is pretty exciting. I want to scale this. I wonder if there's a way to scale it. And I did a survey of my Human Proof Designs audience I guess it was either late 2017 or early 2018, where I said, how more can I help you? What gaps haven't been addressed? And there were lots of different answers. One answer that I think 3 or 4 people gave was people basically say, I don't want to start a site. I don't want to pay you a couple of grand and be a beginner. I've got 50 grand or 100 grand. I want to buy something off Empire Flippers, as you mentioned. I don't know what I'm doing. And so I was thinking, okay, I can either do like a course where I start teaching people how to buy these businesses, or I can do a service where I teach people, where I basically do it for you. I kind of soft launched a course. It did okay. I think I made a few grand, but the service had real legs, and I realized this should be a separate business from Human Proof Designs, partly because I wanted to leave and sell Human Proof Designs, and partly because I felt like I was going to be talking to a different type of investor. So I created Onfolio, which was probably, I think right at the end of 2018, I registered the domain name and just started getting clients. And then I sold Human Proof Designs in April 2019. So it was like I didn't want to sell HPD and then start Onfolio, and the HPD buyer would be like, what is this new thing you're starting? So I wanted to start Onfolio first, so that then a buyer would come in and be like, okay, this is the new thing you're focused on. I'm comfortable with that. Let's work the NDAs and the non-competes and everything, and that was fine. So I left Human Proof Designs and I started scaling Onfolio from there.
It's funny how much reassurance it can give to a buyer, them knowing that like you have a new shiny object and fun thing for you to focus on, and that's the main reason for selling. They don't have as much questions about like where the bodies are buried or if the business is slowly going under, because they know that like, no, entrepreneurs just be entrepreneurs, and they get excited about something new and kind of want to move on. So that's very, very slick how it worked out. And then so as you're raising money for Onfolio, kind of deal by deal, it sounds like, and then you're getting to a point where you kind of have to come up with your like overall thesis. And so were you thinking more the traditional private equity model, where you hold these companies for somewhere between 3 to 5 years, try to scale them and then resell them to kind of give everyone their capital back? Or were you thinking more like Tiny or Berkshire Hathaway, where you wanted to more hold these businesses forever because you thought it would just compound over time?
I was really looking at everything and trying to figure out what was the best model. So originally, we weren't raising money for businesses. We would work with individual investors. So let's say somebody wanted to buy a business for 100K. We'd go out and find them the business. We do the due diligence. We do the negotiation. They would pay. They would own it, and we would get a management fee and a share of some of the profits. So essentially, we were like a kind of real estate property manager. And it was a massive pain because essentially I just realized I was just like a glorified agency. In my head, I thought I was like this private equity person. And so I thought, okay, this isn't the best model. I think there was one other thing, which is actually quite crucial, is a lot of our businesses relied heavily on Google back then. And every time there was a Google update, I think at our peak, we were running 40 different websites for people. And every time there's a Google update, let's say 37 of them were fine, 2 of them benefited from the update, 1 of them got absolutely crushed. And so we'd say, hey, that's a pretty good track record. 40 websites, only 1 of them got crushed. But if you were the guy who had bought that website for, you're not going to be like, well, I'm glad the other 39 people are fine. You're going to be like, what just happened? So I thought, well, hold on, if everybody owns 1/40th of the portfolio, it doesn't matter. Like, it's just diversification. So I started thinking, okay, I want to do that. What's the best way of doing it? And I remember sitting down in my co-working space in, it must have been I think it was late 2019, actually. It may have been even before COVID. And I just wrote pages and pages in this notebook where I was basically thinking, okay, what are the options? Option 1 is start a fund, like you say, raise 5 million, 10 million, something like that. Charge 2 and 20, or 2 and 50 if we can get away with it, because the profits are higher in this business model, and then sell them after 5 years, exactly. Or do we do a holding company? And so you referenced Berkshire Hathaway and Tiny. I hadn't heard of Tiny back then, or maybe I'd loosely heard of Tiny, I can't remember. But I had heard of what you and Fisner was doing with Owl Mountain, and another software version, which I can't remember the name, but it was it's kind of like a very mini Constellation software, but they weren't public. And so I was more interested in this permanent equity holding company model, because I felt like with a fund, you go through all this effort, finding all these businesses, recruiting talent to help run the businesses, and then after 5 years, you have to get rid of it all. And yeah, sure, you can start another fund and potentially sell some of those businesses to the other fund and so on. But it felt like in order for the business model to work from an operational standpoint, I wanted to have a team, like a central team that would be working on everything, and we could compound and we could scale over time. And yeah, that's kind of the direction I was leaning. But I almost started a fund because I felt like maybe a fund's easier. And then, like at the last minute, I thought, no, I'm going to do a holding company. And then I realized it's maybe something I could take public early rather than scale it and then go public later, like Tiny did, because I felt like actually being public would be an accelerant to the growth, and we would be able to potentially use the stock as currency. We potentially there would be prestige, so talent attraction would be easier. Deals would be easier, not necessarily easy, but easier, because sellers are more willing to take less cash up front or take some stock into consideration, or just the visibility that being public brings you. Like, I'm on this podcast because we're public, things like that I wouldn't necessarily have been able to achieve if we stayed private. So that's kind of why we went public so early, because the narrative is still playing out, so it's too early to kind of declare this a success. But so far, a lot of our revenue growth and everything has come because we are public, and a lot of our success, as limited as it may be right now, has come because of that. So that was the theory and the thesis.
No, it makes total sense from a seller's point of view. Knowing that the company is public is, first off, that like your stock is actually going to be liquid. The idea that they can actually look up all your quarterly earnings and actually see what you're up to, and the transparency there would help me sleep at night as a seller a lot more. So that totally makes sense. So go from creating some affiliate sites to creating affiliate sites for other people, and that's kind of one skill set. And then you somehow transfer that skill set into finance and like thinking about splitting up a company between 40 different LPs and going public. Where did you learn all that, like the finance side of business? Was it just you reading books at night? Did you have like a mentor who had already gone public and so they kind of had the roadmap in front of you? Or what gave you the confidence to be able to kind of tackle something that seems so daunting financially?
Kind of all of the above. So reading books, definitely. Reading SEC filings and so on. I had and still have a mentor or a couple of mentors who have taken companies public. They understand the ins and outs and everything. But then it also in terms of things like thinking about the finance of running the portfolio and thinking about spreading risk among 40 sites instead of one site. And we've evolved beyond that now as well. We operate very differently from my original thesis. That's just because I've been doing it. I've been living and breathing it for half a decade. And so there's not a lot of people who say it, but, some of the criticism I've had over the years is like, obviously I don't have a finance background. I have a media background, and then I was an English teacher. So people might think, oh, okay, you're not qualified to be a public company CEO. I think nobody's qualified to be a public company CEO until they're a public company CEO, for the record. But what I am qualified to do is buy companies that are profitable online businesses and build a portfolio around them and run them. And I'm qualified to do that because it's a vocational qualification. You learn it by doing. And so, that's how I learned that. But then, there's finance people you can hire. There's advisors, there's CFOs, there's controllers, and so on, and all of these roles that there are other people out there who've done them. So my real thing is focusing on the deal making and the structure and the direction, what I'm seeing in the space, and all like the kind of things where someone with a finance background would be able to do pretty spreadsheet M&A, but they would fail miserably when it comes to operations, which is what we saw a lot of a lot of companies have blown up because of that. So
reminds me a lot of all the different Amazon aggregators out there.
Exactly, like 100%. They all did. They all had nice MBAs, and everything looked pretty on a spreadsheet. And then they realized they had no idea how to operate a business, or at least how to operate the businesses that they were buying. And so, we're much more the other end. We're operators who figured out finance rather than finance people who try and figure out operations. And I don't know if one is better than the other. This is just the direction that this is just how we've grown.
My experience as an operator, it feels like one is rule-based and the other one is you got to fly by the seat of your pants, hope that you can figure out and put out all the fires all the time. They're definitely two different personality types, but one seems a little bit more trainable than the other one. The other one, you just got to kind of grit and bear it and just learn by doing it on the job and stuff like that. And so, yeah, I think that from the different aggregators I've seen around and the amount of people who went to like Wharton and such for business school, it's interesting to see them now get into this industry where now they're working out of a warehouse. So from you deciding that Onfolio should be a publicly traded company to actually being listed, how long was that process?
About 18 months. Yeah, it was. When did we actually kind of decide let's do it? So the original plan was not to go to NASDAQ. It was to go to an OTC, say OTCQB, for example. And while we were going through that process and getting audited and doing all the preparation for the direct listing, one of my advisors had connections with investment bankers who obviously they're incentivized to take companies public on NASDAQ instead. But they were like, yeah, this is something we could just do on NASDAQ and you could grow faster as a NASDAQ company. You're obviously not ready yet. You need a board, you need to level up in many ways, but you could just go straight to NASDAQ. And so we did a traditional IPO. And I think we filed our S1 to do the IPO like a week before Russia invaded Ukraine. So the timing was epically bad because the markets back then, which was also impacted by inflation, not just like geopolitical situation, but a lot of people were just saying no to IPOs. They weren't even looking, they weren't even picking up the phone, and they were just not doing any IPOs. So it was a tough time. So I think if it had been, let's say, 2021 still, so for people not for people listening, it was August 2022 that we got the IPO over the line after sort of starting down the NASDAQ IPO process in November 2021. Whereas if we'd been trying to IPO, let's say August 2021, we'd have probably raised slightly more money at a higher valuation, and it would have taken half the time. So yeah, it took us almost a year from engagement of the investment bank to IPOing, and about 18 months, or maybe, yeah, between 18 months and 2 years from deciding let's go public to the IPO.
Was that like up there with one of like the worst years of your life as you waited for it, as you saw the kind of market turn and such? That sounds very frustrating, kind of sitting there on the sidelines, wishing you could just like work your way out of it, but you just kind of have to wait.
Yeah, it was super frustrating. I was checking any news of inflation. Every day I was like, did Nasdaq finish up today or did it finish down? It's very cyclical as well, because let's say you file an S1 and then the SEC comes back with comments. I think we had something like 20 comments, which is basically nothing. Like some companies get hundreds and hundreds. So we address those comments, and then you reply to their questions, and then you send it back, and then they have follow-up comments and so on. I think we had 2 or 3 passes there. And this might take, let's say, 6 weeks from file to them saying, okay, no further comments. But then during that period, let's say a quarter ends, so Q1 ends or Q2 ends. So now your financials are out of date. So you have to quickly audit or review your most recent financials, get that added into the S1, file again, and the SEC will probably not have any more questions because they already cleared you before, and all you've done is added a quarter of financial. And so it's like, okay, the SEC's approved you, now you kind of need to try an IPO. And you essentially, I don't know why it works this way. I think it's really not very smart, but it's just the way it works. Basically, you kind of have to declare your intention to IPO, and you might say, right, we're going to IPO on Thursday, and today's Monday. And so between Monday and Thursday, you can take commitments from investors, and you can basically sort of do these things called testing the waters, where you're pitching investors, but you're not necessarily asking them to make a commitment. And then all the money has to be received on IPO day. And so you then, you pick up the phone, you do all these things. Obviously, the investment bank are doing this, and you make a presentation. And in our case, it wasn't really a case of we're trying to raise 15. If we only get 14, that's okay. Because when you're a micro-cap company or a nano-cap company, you have to meet the Nasdaq listing requirements, which means you actually have to sell enough to qualify. So for us, that number was, I think, 15 million or 13.7 million we ended up raising. So the day we finally succeeded, I think we had sold, I think we were something like $200,000 short of the amount we needed to sell in order to IPO. And there was like 2 hours left or something. And our investment bank were like, okay, we're either going to just try again tomorrow, which would have been a terrible mistake, because the next day was the day Nasdaq dropped like 7% or whatever its largest drop was. Or I think it was August 22nd or August 23rd, 2022. Or we're going to go back to all of our existing people who've said yes, they want to buy at $4.50 a share, and see if they'll buy at $5 a share. And then that raises the amount you need. So luckily they went back and investors all agreed, and we got over the line. So there was a 4-month period where you get something filed, the investment bank are like, okay, let's try an IPO. And then they get these soft commitments, and they're like, yeah, we're only going to get 5 million. So let's wait until there's some tailwinds in the markets. And so we ended up in August, there were some IPOs that went before us, which popped after the IPO. So investors got a little bit of FOMO, and people started answering the phone again, and they were like, actually, yeah, we do want to do IPOs. And so more investors looked at our deck and spoke to us, and we obviously got better at pitching as well, because we'd been pitching for 4 or 5 months. And we were able to get it done. But it was very frustrating, because it's like, we don't know when we're going to try. Okay, the investment banks found a fund that might be interested in putting a couple of million in. If they put a couple of million in, some others will come in. And no, actually, that fund have changed their mind because the market just dumped. The inflation report was really bad. Let's try again in 2 weeks. And then 2 weeks later, the quarter's ended. You've got to file, update your financials again. So it was, all the while we're bleeding cash and stuff. So it was it was not a fun time. I lost a couple of kilos, I'm sure.
I've heard too during
Yeah.
that whole process, also people will come out of the woodwork and sue you too, because you can't have like a pending lawsuit without letting the SEC know. So they know that you will just like pay for the lawsuit to go away because you're so close to the finish line. And so, yeah, I can just imagine that on top of everything else going on.
Yeah, I'm glad I wasn't told that. We didn't have any of that. We've actually never had any litigation. Um, but yeah, that doesn't surprise me. The biggest thing that happens is they just shift the terms on you at the last minute. You know, they're like, actually, we could get this IPO done, but you need to do 2 warrants instead of 1 warrant. And the worst is another company will accept that, and then suddenly all your investors will be like, well, we want that. So all the companies are like, if you want to get your IPO done, you have to take that kind of crappy, toxic structure that these other guys just took. And so you're like, well, thanks, everybody. Thanks a lot, you morons.
No, that would drive me nuts.
Yeah, so I mean, we ended up saying no to the toxic stuff, and we ended up, like, again, we caught some tailwinds, and we got it over the line. But it was, I learned a lot that year. Yeah, definitely. That was fun.
In the PayPal book I just finished, they got sued right as they're about to go public because someone had the patent for putting a link in an email. And they said that they had gone against their patent and stuff. And so, yeah, it seems like it can get very petty very quickly. So,
wow, what an amazing patent to have.
So to fast forward to today, what would you say would be kind of the perfect company for Onfolio to buy? From a business model point of view, are you more into software now than doing affiliate stuff? Do you want it to always be like a business operator who's looking to move on to their next thing? What's kind of like the perfect, where all the Venn diagrams meet? What would be the perfect person that you could buy a business from?
Yeah, software's great, for all the reasons why software's great. It's a little bit outside our wheelhouse in many areas, and it's often quite expensive. So it's a little bit prohibitive for us. Not that we buy cheap businesses, but the way we're structured, we tend to pay 3 to 4 times EBITDA for a business, and software is usually, say, 4 to 5 times revenue. So it's just a slightly different investment thesis. So for us, just any online business where digital marketing is really the growth lever. And that actually rules out affiliate sites, because most affiliate sites, they don't really have any lever to grow. They can just pump out more content and hope for the best. So we've been buying a lot of agencies recently, say a B2B agency, like email marketing, advertising agency. We've been buying some online courses. We do have some e-commerce. But really, it's kind of business model agnostic, although there are some business models like FBA and, as I just mentioned, kind of affiliate content businesses that we're not interested in. So what are like the other things? Well, so you were asking about an operator. Does an operator want to stay on? And usually most people selling an online business, they want to move on to the next thing. Maybe they want to buy real estate, or they've got another business, just like we were talking about earlier, like I had the next thing I wanted to do. And so you have to think, okay, will this business survive without that person? Will it thrive without that person? Is there someone else out there we can buy who's going to grow it, and so on? But increasingly, again, part of the thesis of us going public, this is where it's really shining. Increasingly, there's business owners out there who want to sell to us, keep a minority and stay on, because they realize they'll own less of a bigger thing, because they know we can grow their business. So, for example, our most recent acquisition, we've had it for 3 months. So it's, obviously 3 months is a short period of time, but it's already grown. I think it did 1.4 million revenue in the 12 months prior to acquisition, and 3 months later it's on a 2.7 million run rate, which is almost a 2x. And its net income has, again, forward-looking, its net income has 2x already. And a large part of that was because the founder stayed on, the CEO had equity, he stayed on, and one other person had equity and he stayed on. and they still each retain about 4% equity. So it's not a huge amount, but it's not small either. And they have an earn out, and they have all this incentive to grow the business. And us coming in has given them the confidence to go after bigger deals. It's given them the prestige, like, we're owned by a public company. They don't mention that we're like a 2.5 million market cap, but they've got this kind of corporate backstop that allows them to come in and grow. So increasingly, what we want is businesses like that and founders like that, where we're like, yeah, like, listen, we can come in and together we can do something great. Which was kind of my thesis for, a lot of people are like, why would you sell? I own, say, 30% of the company. Management owns 30%, so I own about 22, 23. And people are like, why would you sell 80% of your company? And it's because it's not playing out exactly now, but long term, I want to own a smaller percent of something substantial. And so it's the exact same thing for founders. So I realize as I'm saying this, I'm not necessarily answering your question directly, because you're saying like what type of business, and I'm actually really saying, well, it's more like the type of person and the type of team. But that's kind of the crucial thing, is a lot of these businesses, they're people businesses. You're backing the team, you're backing the founder. What makes a small online business succeed is the embedded knowledge that the business has inside it, which maybe won't, you can't necessarily take somebody out and add somebody else in and expect to see the same results. You can quantify it as much as you can with SOPs and training and so on, but it's just like this deep expertise inside a business. And so finding businesses where we know that's going to stay and the business is going to, we can augment that rather than have to deal with that. That's what's going to lead to success. And I'm aware that's super kind of abstract answer, but yeah, that's what I got at the moment.
But yeah, no worries though. But because I love it. I love the idea of you not only using your skills as an internet marketer, but then even just like arbitraging that you're just more patient than a lot of founders are. And so that you can sit there and make kind of the more long-term decisions as a more professional corporate owner of the business, opposed to someone who every single month the revenue decides their paycheck month after month. And it's more likely that an owner operator, as they scale, if they do scale, will make more kind of emotional decisions, where you can be the rudder to make sure that they stay on course and that they kind of just compound over time and do what's best for the business and don't let emotions get involved. So I love the combination of the two. So that definitely does make sense. Well, as we wrap up here, I just wanted to say thanks for coming on the NanoCap podcast. If people would love to learn a little bit more about what you're working on or sell their business to you, what's the best way to get in contact with Onfolio and you?
You can find me on Twitter or LinkedIn at DomWellsOnfolio is my Twitter handle. You can also subscribe to onfolio.com/newsletter, which is a newsletter I write about once a week, about operating online businesses and deal making, but also some corporate updates from Folio and stuff. And you reply to one of those emails, it's going to find me. Yeah, those are the best ways to find me. And I appreciate you having me on. It's been good. Yeah.
Thanks again, Dom. And for those still listening, please remember to subscribe and review, and we'll see you again soon. Thanks.
Thanks a lot.
This podcast is for informational purposes only and does not provide financial, legal, or any other advice. The information is not investment advice or any offer to buy or sell any securities or to make any investment. The views expressed by the guests are their own, and any reference to third-party products, services, or information does not constitute an endorsement, therefore, by NanoCap Podcast or its affiliates. The NanoCap Podcast express disclaims all liability for any independent